This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and make profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 193. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the microcap message. Now, we announced last week, so I thought we'd put out another little reminder here. We are hosting our next virtual event, the SNN Network Canada virtual event, happening December 7th through 9th, 2021. We at SNN Network, we're teaming up with Paul Andriola and the team at Small Cap Discoveries to highlight our neighbors to the north, Canada. So the website to go and register for that is canada.snn.network. You can expect 3 days of keynotes, educational panels, company presentations, and one-on-ones. We're very excited for the lineup that we're going to be showcasing for you all at this event. So be sure to register and get all the updates as they come. So again, to register, please go to canada.snn.network and click the register button. Now, for this episode of the Planet MicroCap Podcast, I spoke with Derek Pilecki. He is the portfolio manager at Gator Capital Management. After a great recommendation by a friend of the show, Howe from Stock Spinoff Investing, Derek and I found time to connect and discuss all things financials. We chatted about regional banks, Puerto Rico, consumer finance, and what it's like starting a hedge fund in the middle of the global financial crisis. Since launching Gator Capital, his fund's performance has been nothing but stellar, a 21.52% annual compound return. And I really enjoyed finding out why. So thank you again for tuning in to episode 193 of the Planet MicroCap Podcast. And please enjoy my conversation with Derek Pilecki. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And today's guest is we succumbed to the Twitter peer pressure, and we had to pull each other's leg to make this happen. You know, I'm just a shy podcast host. He's just a shy Twitter guy as well. But you know, we made it work. So I'm really excited to welcome on today Derek Pilecki. He is the portfolio manager at Gator Capital Management. Derek, thank you so much for joining me today. How are you doing?
Hey, Bobby, I'm doing well. Thanks for having me on the podcast. Happy to be here.
It's great to have you on, and I really appreciate you taking the time today. So let's dig right in. You know, I usually ask every guest on here, unless I've interviewed them before, you know, I'd love to know where your passion for investing began.
Yeah, I mean, I started investing right in college. I used college as a way to learn as much about investing as I could. So, I mean, I read the Wall Street Journal every day. I would go to the library every day, read the Wall Street Journal cover to cover, bought a few stocks. You know, I graduated from college in 1992. So it was like right before the internet started. So, you know, a lot of the learning was paper-based. I guess where I really developed my passion for investing was I worked at Fannie Mae right out of college, the mortgage company, and I did a lot of reading at night about investing. Like it was I have a different view of Fannie Mae than the rest of the world. Like I think it was a great first job in finance for me. And I read as much as I could about that markets at home every night. And, you know, I read Roger Lowenstein's biography on Buffett, The Making of American Capitalist. And when I read that, I was like, I want to manage a portfolio, but I knew, you know, I was 24, 25 at the time. I knew I needed to get training, and it was going to be a long journey to open up a fund or, you know, become a portfolio manager. So like that kind of just sparked my path towards trying to become a professional investor.
Absolutely. So, I mean, I got to go back to when you were, still in college and going to read, the Wall Street Journal cover to cover. I mean, what inspired you to do that, even prior to then going and working at Fannie Mae?
I learned about the stock market from my grandfather when, growing up, I was a baseball fan, right? And so I'd like Sunday morning and I'd read they'd publish everybody's batting average. And it was only Sunday, through the week, they'd publish like the top 15 batters in each league. And, I'd study them. And then on Sundays, it was a big day because they publish all the entire league. And, but then Monday would come around and all of a sudden there's the business page was right next to the sports page. And I was like, well, what are these numbers? Like, I love numbers. There's not batting averages. I don't recognize any of these players. My grandfather explained, no, these are companies. And, he used Exxon as an example. Like, this is in the 80s, like oil, before the oil crash in the 80s, like Exxon was the biggest company in the country, or biggest market cap. And he explained, like, this is the stock price. It changes every day. And, here's volume. And he just explained what the pages were. And it was a little, it was a lot for me to understand at the time, but I just tried to learn as much as I could about investing and business that is the start.
Well, I'm also a huge baseball fan. So before we continue, I got to ask who your team is. Of course, you can see my team pretty much, right? All you have to see is the two, and you know who it is. So who's your team?
I've lived in Tampa for 18 years, so I've adopted the Rays. I was born in Philadelphia, so when I was a kid, the Phillies were my team, right? So Mike Schmidt's my baseball hero. I went to his Hall of Fame induction ceremony, but
that's cool.
The Rays are hard not to root for, right? I mean, they're the huge underdogs. The American League East is a tough division, and really impressed with how they navigate the season year to year with less resources than the Red Sox and Yankees. So,
listen, I got to tell you, I think you might be the first Rays fan I've ever met. So I kudos. I figured it was mostly just Yankee fans in the stands, or the other team stands in the pen. So this is debunking that myth for me. So I again apologize to all your Rays fans. Enjoy your success. Okay, you're doing great. All right, but yeah. So this is big news for me.
Yeah, well, we're going to the game tomorrow. Got it. Our magic number is, I think it's 7 now. So we got to get. Hopefully by the time you publish this podcast that we've clinched the American League East this year. So it's exciting. It doesn't happen all the time. So got to enjoy it while it's happening.
For sure. All right. So let's get back to finance investing. Sure. So catch us up. So tell us a little about from when you were at Fannie Mae to then when you launched Gator Capital.
Yeah. So, I decided at Fannie Mae that I wanted to become an investor professionally. I guess at Fannie Mae, I had the role of, I was an analyst in our asset liability management. So like my group would forecast net interest income for the firm and do budgets and do market measures of risk. And my job was to load all the assets and liabilities of the company into a computer so that we could do a model run. And this is like circa 1995. And it would take like 10 hours to do one interest rate scenario. So like if I didn't load everything in perfectly, I wasted 10 hours of computer time. So like I knew that balance sheet at a CUSIP level. And it was a great lesson in fixed income, right? Fannie owns a bunch of mortgages and mortgage-backed securities and CMOs, and then they fund their liabilities by selling agency debt, callable bonds, structured notes. And then, a lot of the structured notes, they swap back to LIBOR floaters. So, it was just a great education in finance for me. But, I didn't want to run a bond portfolio. I want to run an equity portfolio. Like at night, we'd all stand around the Bloomberg and pitch stocks to each other, right? And we're not pitching, I really like the Fannie sixes here. Like you pitch like, I like Cisco, or I like, Bank of America. So, just developed, I knew I needed to move to equity research, and I didn't think I could do that directly from Fannie Mae. So I went back to business school at Chicago and used that as the pivot to equity research. And so, I love Chicago. I was in the class of 2000 of Chicago. So there's some, pretty good professional investors that were in my class, like, Dan Kozlowski, who was at Janus for a while, was there. Josh Spencer, who runs the tech fund at T. Rowe Price, was there. Matt Freeman, who runs the Fidelity Value Fund, was in my class. And so like, I felt like we were lucky that we had some top-notch investors in that class at Chicago. It was a great learning experience. And then, I got a job at the buy side at a small firm in Chicago. I transitioned to another firm in Rochester, a deep value firm in Rochester, New York called Clover Capital. And I loved that job, but I was in the job for a couple of years, and a classmate of mine from Chicago called me up and said, "Hey, I've been working at GSAM, Goldman's Asset Management, and our bank analyst just retired, and we own a bunch of Fannie Mae stock. Will you please come interview?" Because he knew I had worked at Fannie Mae. And so I was like, I like my job. And he's like, "Come on, this is a good job." And so I went and interviewed for the Goldman bank analyst job on the buy side. And, I got the offer because they owned Fannie and they needed help of managing that position. So, I moved to Florida to work for GSAM. GSAM had bought this money manager that had been part of Raymond James. And so moved to Tampa in 2002 and, worked for GSAM for 5 years. And, it was unfortunate. Fannie and Freddie ran into trouble almost coincidentally with me starting at GSAM. So like, it was not fun managing those positions for GSAM. Freddie had its earnings issues, and then Fannie had its accounting issues, and then we ran into the housing crisis. And so, I wasn't having a great time at GSAM in 2008, and I was like, I want to go run my own portfolio rather than being an analyst. I felt like I'd worked for a couple firms, gotten a good professional training, and it was time to go start Gator. And so I launched Gator in mid 2008.
Very cool. All right. So before we get to Gator and investment philosophy, other than when you were doing all your own research yourself, what would you say was the biggest lessons you learned that prior to founding Gator Capital in 2008?
Yeah. So I've always been drawn to value investing. I kind of think your investing style fits your personality, right? And so I'm always looking for bargains, or I don't want to overpay for things. And in a market like right now, that's a painful disposition to have, because the most expensive stocks go up the most right now. And so I don't think that's a permanent state of affairs. Like, I think the market right now is very much like 1999. So just as a background, I was just naturally drawn to being a value investor. I think Fannie Mae was a value investor in the bond market. They were always looking for value. I worked at a deep value firm. I guess I did a lot of reading. I was drawn to all the books that have been written about Buffett. I attended a few annual meetings, and I wanted to expand beyond just value investing to GARP investing or growth investing. And the Goldman team I worked for was more GARP investors. And so covering financials for a growth team just gives you a little bit different perspective. I guess one of the things that really opened my eyes was when I got to Clover, which was this deep value firm. I was like, okay, these guys are going to do great fundamental research. This is going to be a great lesson. And within like the first few weeks of getting there, they're like, we've put a technical analysis overlay on our fundamental investing to try to improve our entry points. I was like, whoa, like that was not what I was expecting. And so, but it was well reasoned. Like, I guess the value market, this might seem like ancient history to a lot of people, but the 1998 value stocks were terrible, right? The mid 90s bull market value stocks did great. And then kind of like 97, they peaked out. And while growth stocks continued to do well through the rest of the decade, 98, 99, 2000, or 98, 99, really, value stocks were really a tough place to be. And I think that was a tough for that, even though I wasn't at that firm during that time period, their lesson was there's a lot of stocks that they got cheap, and they kept getting cheaper, and they got into stocks too early. Kind of a value investor buys too early and they sell too early, right? And they were trying to improve those entry and exit points. And so they said, a lot of times, if you look at a stock chart, the the stock chart might look ugly. It's at a value that you want to buy, but it might get cheaper, and you just have to wait and better pick your price. And then on the exit side, they used to have firm price targets of, okay, when this bank gets the 13 times earnings, that's too expensive. Banks can't trade at 13 times earnings, but sometimes banks trade up to 18 times earnings. So they tried to use some technical analysis to improve their sell points too. So I think that was an unexpected learning that I had working at a value firm to overlay some technical analysis. So
very cool. All right, so now we're here at Gator Capital. I would love to learn, and you've already alluded to this a little bit as well, but what would you say is the firm's and yours in turn, your investing framework, and what would you say is your focus and why?
Yeah, so at Gator, we focus on the financial sector because that's where my expertise is. So, I think that the financial sector is one of the few sectors where you really need to have specialization. So, I think energy and biotech and financials, you need specialists to cover those sectors or invest in those sectors for people. Like, it's hard for generalists to just kind of show up and say, oh, this stock's cheap or whatever. And so I've really focused on going deep within the sector, and really, there's about 1,000 publicly traded financials. 600 of them are microcap banks. And so the other 400 are larger banks, capital markets firms, insurance, REITs, exchanges. And so, I really have focused on knowing those companies. And, I can't say that all 400 companies I know cold, but I've pretty much read the annual reports for most of those companies. And so I use a value perspective. So I'm trying to buy stocks that I think are misunderstood and they're cheap, and that misunderstanding it by the market is going to get corrected somehow, that people are too negative for some reason. And a lot of times that valuation, will change when people come to realize that concern is passing. I think we're seeing that the financial sector has been this way for a long time, that so many generalists lost money in the financial sector during the financial crisis that they've ignored the sector. And, I talked to tons and tons of funds that are like, oh, we're a generalist fund, but we don't do much in financials, or we're a generalist fund and we really like Wells Fargo. I'm like, yeah, that's great. Like, Wells Fargo is pretty cheap and it's a good turnaround, but there's a lot of other more interesting stocks in the sector. And so I think that it's fertile ground for doing some work and applying some knowledge.
I literally was just going to ask you, what would you say has been the most misunderstood aspect about the financial sector right now? But it sounds like that's one of the things, is that most generalists have just ignored it since the financial crisis in 2007, 2008. I mean, yeah. Is there anything else that's been largely gone misunderstood about the space?
I think, so people look at long-term returns of different sectors, and the financials had a great long-term return up until the financial crisis. And then there was major big cap stocks that either went to zero or were down 90%. So AIG, Citigroup, Fannie, Freddie, WAMU, Wachovia, just huge impairments of value. And, a lot of Bear Stearns, Lehman, so many large cap financials went down. If you look at the overall returns of the sector, it lags a lot of the other sectors, and people just think it's not a really good sector. Well, I think of that as a once in a lifetime type episode. And, it happened during the Great Depression. The financial stocks got impaired. Maybe you could argue during the SNL crisis in the 89, 90 timeframe, they got impaired. But then, 08 was a huge, huge deal. And with the change in Dodd-Frank laws, like, there's a lot more capital in the sector. And I think also the management teams really got scarred by that experience of 08. So I don't expect in the next cycle that the banks will have anywhere near as severe a cycle as they had in 08. And so I think that's going to, I could even look forward I think that might persist for the next 20 years. Like, we're not going to have an 08 type scenario again, because the banks can't legally, because they have a lot more capital and the management teams have learned their lesson. So I think, it's one of even though the banks are volatile, I think it's one of the safest times to own banks in, as far as if you think about an investing career. And I just think the generalists who ignore financials are missing that change.
So then what are some of your criteria when you're looking at potential investment in banks or any other business in the financial sector?
Yeah, well, I think it's, I think there's several things. I think high returns on capital, and management teams that try to create value through capital management. So, they're buying back stock when it's cheap. They're not buying back stock when it's expensive. They're doing smart acquisitions if they can, or they're not avoiding dumb deals. So I think that aspect is very important. And then, I think there's a lot of companies that have a little twist to the normal industry model that allows them to grow faster than the rest of the industry. So like there's tons of banks, right? And there's a lot of generic banks that are not that interesting, but there's some banks that have demonstrated they're able to grow faster than others. And I think that's super interesting. And they tend to have higher returns because of that. So you can look at companies like Silicon Valley Bank shares or Western Alliance or Pinnacle Financial in Tennessee. They've all been great growth banks for a couple decades. And I think that will continue compared to some of the generic, large regional banks that have okay returns on capital, but not a lot of growth. So just looking for something twist that allows some twist to the business model that allows them to grow a little faster or produce higher returns on capital.
Very good. And by the way, are you a shareholder in any of those three companies that you just mentioned?
Sure. I do own Western Alliance and Pinnacle. Unfortunately, I do not own Silicon Valley at the moment.
All right, very good. So actually in the Gator Capital investor deck that you sent over, one of the slides has here on prospective investment themes in the portfolio. And you mentioned 4 categories here in Puerto Rico banks, consumer finance, small banks, and then hard P&C insurance market. So, why these 4 spaces in particular do you tend to focus on?
Yeah. So a lot of my investing is bottom up, analyzing companies for being misunderstood. Valuations are cheap. I think the valuations will change. And sometimes I'll look at a sector and look at similar, once I find a company that I like Puerto Rican banks, I like OFG Bancorp. And so once I like that, I look at its competitors and those stocks look attractive too. And the stories are similar. Like the Puerto Rico banking market has consolidated. Back in 2007, there were 12 Puerto Rican banks for an island of like 5 million people. And now there's 3. And so it's almost like an oligopoly there. And if you compare Puerto Rico to another island market like Hawaii, there's only 4 banks in Hawaii. Bank of America and Wells Fargo exited Hawaii. So like it's 4 local Hawaiian banks and they earn high returns and high margins and they have high stock valuations. Where in Puerto Rico, it's an oligopoly. They haven't quite gotten their margins up because it's a process. So I think their margins are expanding and I think the valuation will expand once the margins expand. So I think it's, Puerto Rico is changing to an oligopoly market. And I think that's interesting. I would say that maybe Puerto Rico doesn't get the same valuation that Hawaii does long-term because it's a territory versus a state. But I think, Puerto Rico they're U.S. citizens and the banks are regulated by the FDIC. So they're American banks. And so it's not like I said, I think Puerto Rico banks. It's just, I found a Puerto Rico bank and I was like,
right.
Oh, the story's good. And so then I look around. So the same thing with the other sectors, like consumer finance. We've long held positions in consumer finance stocks. I think consumer finance companies grow faster than banks, have higher returns, but they're cheaper than banks. So I think that's an evergreen opportunity. I think small banks in this rally that we've had in banks from last September through March of this year, it was really driven by the large cap banks and the small cap banks kind of got left in the dust. And so I think there's an opportunity right now with very small banks. And part of that's driven by the Russell reconstitution. There's so many new IPOs and SPACs that came out this year that the minimum cutoff for the Russell 2000 inclusion every June has risen from 90 million to 245 million. And so there were 79 banks that got booted out of the Russell. And a lot of those banks trade for book value, 7 or 8 times earnings, and they're operating just fine. They just had a big dumb index seller in June. And so I think there's some interesting values in small banks. So that, it's the kind of bubbles up from the bottom of, ways to describe the portfolio rather than being thematic investing.
Got it. Okay. Yeah. No, I was just curious because, it was in the investor deck. So I didn't know if that became your specialization or it's kind of the flavor. It's the flavor right now, and then, at a certain point. So I wanted to actually zone in on one of the, I believe it's in consumer finance. One of your current long ideas that's in the investor deck, Navient, which is a student loan company. So I would love to hear your insights, not just on this idea in general, but just really the student loan area as well. I mean, it gets a lot of headlines and, loans are getting forgiven and stuff like that. So love to hear your commentary there.
Yeah. So I think the student lenders are very interesting because they're hard to understand. Like there's only 3 of them that are publicly traded, right? It's Nelnet, Sallie Mae, and Navient. And so the amount of time that an analyst or portfolio manager would have to spend on them to come up to speed, to have a view, I think they just trade cheap because it's a lot of time to spend on just 3 small companies. I think the student loan market is super interesting. It's changed a lot. So 90% of student loans are made by the federal government and 10% of loans are private loans. And so those loans are, they tend to be for the more expensive schools or for grad programs. And, so like the first $17,000 you borrow for undergrad are government loans. And then if you have to borrow more than that, you go to a private lender. And Sallie Mae dominates that market with 55% of the market share. So it's pretty stable pricing, pretty attractive margins. Sallie Mae's pricing is like LIBOR plus 600, like super wide margins. It's risky. You're lending to 18 and 19-year-olds they're not going to start paying back till they're 23. But there's an umbrella there, a pricing umbrella that allows Navient to come in and refinance some of the better loans away from Sallie Mae. Navient and Sallie Mae used to be the same part of the same company, and they were as a spinoff back in, I think it was in 2014. And Navient took the existing portfolio and they were going to hold it. And as those loans paid off, they used the capital to either buy new student loans or buy back stock. And then Sallie Mae took the loan origination platform, and that was the growth story. And that played out. Navient has done a good job of refinancing liabilities, finding other portfolios to buy. And so their earnings, although it was supposed to be like a decaying business, their earnings have actually grown over time. So, I first got involved with Navient right as COVID was hitting last year. So like Navient was going to do $3 and I bought the stock at 10. So it traded for 3 times earnings. And COVID was hitting. It was a little scary for a while, but Navient traded down to $5, like within 2 weeks of owning it. And so, but with the loan forgiveness and, the amount of time that people have to pay back their loans, I thought, worst case scenario, Navient just gives everybody a 6-month payment holiday and just tack the 6 months onto the end of the loan. Student loans aren't forgivable in bankruptcy. So I thought Navient would sail through just fine. But it was scary. Their earnings are hard to understand because they have some derivatives and mark-to-market issues. But at $5, if they earn $3, it was like a 1.5 P multiple. Is just kind of crazy cheap. Even coming into this year, Navient still only was at 10. Now it's doubled year to date, or a little bit more than doubled year to date. So I think it's trading at 8 times earnings, and it had a standstill agreement with Sallie Mae. So for 5 years after the spinoff, Navient couldn't go to colleges and originate student loans on campus, and that standstill agreement expired. So now Navient's starting to originate student loans on campus, and their loan portfolio this year should flip from declining, through payoffs to actually growing. And so I think that will change investors' perception about Navient and the multiple you should pay for their earnings. So.
Very good. I mean, so then coming out of that experience, looking at the student loan market, I mean, because it's interesting, I have student loans, right? And the one thing that is, we don't have to make payments on because they're all federal government loans,
Right.
That got suspended until next year. But I have friends that refinance with private banks. They've been having to pay that back this entire time. I don't even think they had any kind of forgiveness time. So I feel like that's been the biggest misunderstood aspect when you think about the student loan space, is that even in that 10% market of private loans, they haven't had to stop.
Yeah, they're still paying. Yeah,
they're still paying, and because that interest is accruing. Versus the federal side, I mean, the interest isn't accruing, so you can either just pay lump sums or wait.
Yeah, and I think, I think the student lenders for a long time have had this cloud over them. College, will anybody take out a student loan? Or, if they pay off all the student loans, what will happen to their portfolios? Well, it's kind of similar to what you're talking about. If federal government decides to forgive a bunch of student loan debt, they're not going to forgive the private loans. They're going to forgive the loans that are government guaranteed. And then, if you look at free college, New York has had free college, but there's restrictions placed on people. Like, you have to commit to living in New York for 5 years. You have to get a B average. Your family can't make more than $125,000. And so that doesn't, not everybody qualifies for that. So you still have to get student loans, and you also have to go to a New York State school. So if you wanted to go to Colgate instead of SUNY Stony Brook, you're taking out student loans. And so the student loan market won't go to zero. I think Sallie Mae and Navient's loans in the New York state system went down for 1 year, and 2 years later they were higher than they were before the free college offer. And so it's a scary headline, oh, free college, but student lending still persists. I would say that I am concerned that student tuition is stretched so far that I don't know that schools will continue to raise tuition prices or be able to, or the number of schools that exist will decline. I do worry that we're stretched on that aspect, but people will still go to grad school, and there's plenty of people who are willing to pay for education. That I think the student loan market will persist.
When you're talking to your LPs and, March 2020 happens and they see that you're concentrated in small banks and student loans and insurance. I mean, what were those conversations like in March 2020? I mean, was it stay the course, or hey, you have every right to be worried? No idea what we're getting into right now. I mean, what were those conversations like?
I've been doing this for 13 years, and I've been blessed with a LP base that is very in tune with my investing style. And so I think when we go through hiccups like that, they're not expecting me to outperform on the downside. They're expecting me to bounce with the market. And so I don't think people were upset or surprised by my March 2020 performance. And, when I bounced through the summer, that's what they expected. If I had not recovered quickly after March, I think I would have gotten some angry phone calls. But I think I got some calls of, is this a good time to add money? I got a lot of people who are that's kind of what I expected. So, I was lucky. I did not have any redemptions until August. And so it was, I am very grateful for my LP base. They've been with me for a long time on average. And they did not panic at the bottom, so which made it a lot easier to manage the money and try to pick the spots to outperform on the recovery.
Right, but at the same time, I mean, how do you manage that headline risk? Because I mean, you're in spaces that more so than most, it's the headline risk is just ever present.
I mean, I think March 2020, I did not think consumer finance was going to be the ground zero for the stock market. There was a run on the bank. There was a liquidity crisis, and I didn't. We all knew that the pandemic was coming and the case counts were getting higher. I didn't think it would focus on mortgage REITs and consumer finance companies would be the biggest problems. And so that was the huge surprise. Like, and then oil went down, and I think the following Monday, regional banks index was down 16% in one day. I mean, that was kind of crazy. It was, I remember having conversations with my analysts like, is SunTrust or Truist going to go bankrupt? And, of course they didn't, they didn't come close, but, just the way the stocks were trading, it was like, everybody thinks these companies are worthless. And it was just a huge run on the bank. People were looking for liquidity wherever they could. And, I did not expect that to be that bad.
Absolutely. So another question on the fund construction. I mean, would you say the portfolio is more concentrated, tends to be more diversified, somewhere in the middle? And how did you think about that?
I mean, I usually have 25 names on the long side, but I think, I know a lot of investors have 10 or 15 names, but all 25 of my names are in one sector. So I feel like that's pretty concentrated. Like it's, they all trade in line. Insurance varies some from capital markets, from banks, but in a crash they all go down. And so like I think it's relatively concentrated. Recently, when I've been adding to small banks, I haven't been buying as large of position sizes just to preserve liquidity in the portfolio. So the number of names has crept up a little bit, but it's, I feel like the small banks are interchangeable to a large extent. So it's the same trade, whether I own, if I have 30% of the portfolio in small banks, whether I have, 4% positions or 2% positions, it's the same trade.
Absolutely. Do you like talking to management? I mean, some of these smaller banks are smaller market caps. There's a little bit more access to management teams. I mean, do you like to chat with them and get their perspective and do all that? Is that part of your due diligence process or no?
Oh, absolutely. Like I like that the management teams don't change in my sector a lot. Like I like the maintenance research and financials is a little bit easier than consumer tech, right? I mean, you don't have product cycles. It's loans and checking accounts. Like you're not trying to look at do channel checks, like how many checking accounts did you open this week, right? Or this month. So it's a little more long-term from that standpoint. Like once you know the management team, their track record and, where they're focused on adding value, you can maintain that dialogue over a period of years and it doesn't change quarter to quarter, right? So I like meeting the management teams before I buy the stock. I like most of the management teams. I guess one thing that I learned when we were at GSAM, I felt like we really knew the management teams well. And I felt like there were times where you become friends with the management team and you kind of lose a little bit of objectivity. So like, I don't like getting close and being buddies with management teams, but I respect them and I try to learn about their businesses from them, but I don't want to know what they had for breakfast.
Fair enough. I don't think anybody wants to know what some of these management teams had for breakfast. I know you're kidding, but all right. I'm going to throw you this could be like the dumbest question anybody's ever asked somebody that focuses financials. I tend to ask dumb questions every once in a while. So
sure.
Do you think about crypto at all when you think about some of your bank? So how do you evaluate cryptocurrency? Do you see it as a risk? Do you see it as a long-term opportunity or tailwind for some of your positions in some of these banks that you own or consumer finance or anything? Love to hear your take on that.
Yeah. So I like learning about crypto. I think recently there's been changes. For a long time, I was a doubter about crypto because with the Patriot Act, the federal government likes to know who has the money and where the money's going. And so like, I just discounted the aspect of crypto that you could hide yourself from the government. Like, I just didn't think that was going to fly with the regulators. But, that's changed in my view in the last 18 months. I think, some important players like Coinbase are willing to report transactions to the federal government. So I think that was what changed my mind about crypto. Like, it's going to be around for a while, and it's going to be an important asset class. And so I think that's opportunity for a lot of companies in my space. I think it's, we see it with a few banks that are providing deposit accounts for stable coins. I think the business models of the Coinbases of the world are pretty interesting. Interactive Brokers just announced you could trade coins. Fidelity's working along those lines. I think that's an important revenue source for a lot of the brokers, and so I think it's very, very interesting development.
I mean, have you talked to some of the management teams and some of the positions that you have, and be like, hey, is there plans? Are you looking at it? What's been some of the responses?
Yeah, I mean, it varies. So like, I own shares in Axos Bank in San Diego, and I think they're just a very good management team, very forward thinking. They try to grow the bank in a very thoughtful, organic manner, and they just bought a clearing business, and they're going to grow that side of the business, and they get some benefits on the bank side from the clearing business, and they're providing services to broker dealers and RIAs, and they're adding crypto trading capability to for their customers to be the broker dealers that trade on their platform. So I think within my portfolio, that's the one holding that's really trying to take advantage of it. A lot of the regional banks or small banks, it's not a factor yet. And I guess I've recently been doing some work on title insurance, which is one of the biggest threats to title insurance is the blockchain, right? I mean, title insurance, some people think it's a scam, right? Meaning we all overpay for title when we want to buy a house. But those companies throw off a lot of cash and they trade cheap. So, is that business going to disintegrate because of the blockchain? I don't know, but doing a lot of learning right now.
Absolutely. So my one last question on looking in the financial sector. I mean, what would you say are some of the overall opportunities? And then, I mean, we already kind of talked about some of the concerns, but what would you say are some of the overall opportunities now moving forward that get you really excited about financials on a daily basis, at least moving forward?
Yeah. So I think I mentioned this earlier. I think the market is very much like 1999, where there's some expensive stocks and some crazy frothy stocks. And then there's a lot of businesses that are pretty reasonable valuations. And I think a lot of those good valuations are within the financial sector. I think, if you look at banks, generally they trade cheap relative to the rest of the market. Like they usually trade 85 or 90% of the market multiple. I think right now it's like 58% of the market multiple. So banks are cheap relative to the market, cheaper than they usually are, right? And I think that's super interesting, especially since interest rates are zero. And if rates go to 1 or 2%, the bank's earnings are going to take a stair step higher. And so you have cheap valuations on, under earning business models. So like you raise rates and then you get a reasonable valuation on the higher rates, and banks should have pretty nice returns. So I think that's interesting. I see so many interesting areas with financials. It's kind of picking like which is going to move first. So like, I think everything related to housing has lagged surprisingly. Like, so mortgage insurance, some mortgage brokers, title insurance. I think those are all interesting businesses that are printing cash in this housing market, and the stocks really haven't moved. So I think that's interesting. I think European banks are super interesting, especially if rates go up in Europe. Like those things trade super cheap. Like I own Barclays and NatWest Group. I think Barclays is 60% a tangible book, and they're buying back 5% of the stock. And if rates go up, I mean, their income statement's going to explode higher. So it's kind of trying to decide, okay, which of these cheap groups is going to realize the value first. We talked about consumer finance and Puerto Rican banks, small banks, and then insurance. We're going through a hard market insurance. So hard market insurance insurance prices are going up. So like if you've had a insurance policy, your rate probably renewed much higher this year versus last year. And we haven't had a hard market since 2001, 2002. And it's just an opportunity for the disciplined underwriters and insurance to expand their business and put on more risk. And so I think there's a lot of interesting opportunities within financials that people just don't, it's not in the general investment conversation.
Very good. All right. Well, we're at that part of the interview where it's my favorite question to ask. And you've kind of touched on it already. So if there's another story here, I'd love to hear it. But what would you say is an investing experience that really changed your career, either the most, or if you already told us the most, then number 2 or 3?
Yeah. So, I guess so I launched my fund July 1st of 2008. So 10 weeks before they shot Lehman Brothers, I launched a financial services fund, right? So and I had dreamed about this since I was 24, 25. I think on the second date with my wife, she knew that I was going to launch a hedge fund. She didn't, it wasn't going to happen then, but it was eventually going to happen. And so, I'd saved, we lived very modestly when I worked at Goldman, saved up a bunch of money, launched the hedge fund, and the crash happened and I got torched. And I was like, I had hired an analyst and I moved him down to Tampa. I'm like, whoa, that dream of having a hedge fund just went by really quickly. And so, I gave him two weeks severance, said, go to New York and go get a job. I'm sorry, it didn't work out. But then October 1st, 2008, I sat down at my desk at home and I was like, whoa, I had saved all this money and now my balance sheet's upside down. I need to make money today. And I traded October 1st and I made like $5,000. And I made money almost every day in October 2008 when the market went down 16%. I just focused like, today I'm making money. And it was one of those things where your back's up against the wall and you have to either succeed or fail. And, I was able to scratch out some gains. So I only finished 2008 down 14 or 15%. And then I kind of caught 2009 very well. Like I was, I thought that the credit markets were going to heal, and I thought that they weren't going to nationalize any more big banks, but I wasn't certain. And so, I was kind of neutral during early 2009, and I made money the first couple months of 2009 in a down market. And then, this is going to sound crazy. My research is a little bit more deep than this, but when in the end of February of 2009, Citigroup got its third bailout. Like they did a preferred for common swap. And it was like, well, if Citigroup gets that deal, they're going to give a better deal to Bank of America. So Bank of America is not going to go under. And Bank of America's preferreds were trading for like 30 cents on the dollar that morning. So I bought, a 6% position in Bank of America preferreds at 30 cents on the dollar. And they finished 2009 at par. Bill Ackman was talking about walking GGP through bankruptcy. The stock was at 60 cents when when GGP actually declared bankruptcy. The stock went to 42 cents, and I bought 1% position at 42 cents, and it finished the year at $8.50. So it was like a 20 bagger. And then the first Sunday in March, Ben Bernanke was on 60 Minutes, and he said, we're not going to nationalize any more big banks. And I turned to my wife and I was like, he just rang the bell. That's the bottom. That's what the market needed here. And the market bottomed 2 days later. And so when I heard him say that, I went in and bought every formerly large cap bank that was trading under $5 and just, Fifth Third, Regions, SunTrust, whatever, just bought a bunch of them and, kind of caught that. I sold them all too early. Right. But they were either doubles or triples within 60 days. So, I caught 2009 correctly. And so I think that transforming experience from like October 1st, 2008 to like April 30th, 2009 was, it was painful for a lot of people, but I was able to just focus on the very short term and make smart decisions and make money and get a good start, turn around the start of the hedge fund. So
that's a great story. I was hoping, listen, for everybody listening, when he talked about how Derek started his fund when he did, I was going to get to that. So I'm glad that you told that story. I'm very happy you did it. I mean, what a time, right? Like I mean,
Yeah, crazy.
How much money went into Scotch for those 6 months? I mean, just a little bit, right?
I mean, there have been several periods running this hedge fund where I have not slept, and I would say that was the first one.
That was the first one.
Yeah, like there was not a lot of sleep going on during that time period, but it's also invigorating and kind of life transforming. Right?
Yeah, I mean, when are other times where you're just like you're holding the bottle for a second, just like, uh-oh. I mean, is it when I guess Brexit? I guess Brexit must have been a big one.
Yeah. So Brexit happened. Brexit was kind of towards the end of a period. So the previous summer when Puerto Rico said they weren't going to honor their debts, and I owned Puerto Rican banks and the bond insurers. Then that was pretty tough. And then I also owned the private equity firms. And when the high yield market fell out of bed in the fall of 2015, the private equity firms didn't do too well. So, I mean, that whole time period from, middle of 2015 through the middle of 2016 was a tough one. The end of 2018 was not fun, obviously March of 2020. So there, it also changes like 08, 09, it was stressful, but I didn't really have investors in the fund. I was the only investor. When 15 and 16 happened, I had grown the fund to a pretty decent size, and I was, you just feel a lot more responsibility for your LP's money. And so that's super stressful when people have placed their trust in you and you're not making them money or you're losing money. That you don't want to let people down. And I take that very seriously.
I mean, look, I'm sure they're not that upset when you have a greater than 21.7% annual. What was that? I think that's your compounded growth since your start in 08, right?
Yes, it is.
Yeah. Yes. I'm sure they're happy now. So, before I let you go here today, and again, thank you for spending time with me and telling us your story and your investing philosophy and framework. So, what advice would you have for investors that might be looking at banks for the first time, or just the financial sector in general? What are some things that you'd like them to know?
Yeah, I would say, I guess the things that I like I think banks are a tough sector. Like, I think the long-term banks are becoming more competitive, and the competitive intensity of banking is increasing. So, interstate branching laws went away 25 years ago. I think it's going to be hard going forward, but I think there's some management teams that have outperformed over a long period of time, and I think that past success will continue going forward. I also think that, I think that if you take a long-term view of banks, you can make more money. I think if you worry about what rates are doing today or the shape of the yield curve, I think that a lot of that's noise. So if you see banks trading off because of yield curves flattening, I would just ignore that. I focus on the banks that grow their deposits and grow their loans and have high returns on equity. And I think you'll do well with that, with those metrics.
Very good. Well, Derek, we're there, man. Where can our audience go and find more information on you, follow you, as well as learn more about Gator Capital?
Yeah. So if you sign up for our newsletter on gatorcapital.com, be happy to send you research as we publish it. I also tweet sporadically on Twitter, Gator Capital. And, my phone number and email address are on our website. So, if you want to reach out and talk to me, I'm always open to conversations with investors.
Very good. And, I'm sure a lot of people have been wondering, but did you didn't go to the University of Florida, right? Just
no.
Like, we got to make sure this is the most important disclosure of the entire interview right now.
I did not go to UF. So if you went to Florida State, you can still invest with me, right? So, so when I was at Goldman, we used to make fun of the stupid hedge fund names. And then when I started a hedge fund, I was like, oh man, I need to pick one of these names. And I was surprised. I wanted something regional sounding, which in hindsight might not have been good, because a Florida-based hedge fund, people don't love that. Like, people in the Northeast don't like that I'm in Florida. So this was probably, in hindsight, wasn't the smartest thing, but I didn't want to call it Sunshine Capital or Palm Tree Capital. And I was surprised nobody had taken Gator Capital. So I had, I actually got the domain name from a high school baseball coach in New Jersey who was a University of Delaware grad, and he called his investment club Blue Hen Capital. And he's like, "Hey, this is kind of cool. I bet a lot of hedge fund guys would name their fund after their college mascot." And so he went and bought all the college mascots and capital.coms. And so I had to negotiate with him to get Gator Capital from him. So the guy who runs Wolverine Capital was the other sale he had made. And so I bought Gator Capital from him.
That's kind of brilliant. I hope he also got like gatorcap.com, like the shortened version, so that, because I'm sure everyone's like, oh, well, I'll just get around it with that. Or gatorcm.com.
I should probably go to my GoDaddy account and buy those up right now.
For sure. Well, with that, Derek, thank you so much for joining me today. This is a lot of fun. I really, again, appreciate you taking the time, and I look forward to our next conversation.
That sounds great, Bobby. Thanks for having me on. Good talking to you.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.